Paraguay does not have a double taxation agreement with the country I'm living. Is that a problem or not? Short answer, no. In this video, I'll explain to you why it's actually much better that your country and Paraguay don't have a double taxation agreement and what would change if they did. To start, what exactly is a double taxation agreement? It's a treaty between two countries that determines how to handle taxation for individuals and businesses that have presence or interest in both countries. These agreements typically cover several areas. One part is dedicated to companies dealing with things like permanent establishments, VAT collection, dividend payments, and so on. And then there's a section that has specific forms of income, such as royalties and interest payments. But that part that matters the most to us is how to determine whether a person is a tax resident in one country or the other. That's the juicy part we're interested in. So, Paraguay has ratified very few double taxation agreements into law, specifically with Germany, Qatar, and the United Arab Emirates, Chile, Uruguay, and Taiwan. Also, Spain has joined the list starting the 1st of January of 2025. Two countries are free to manage these issues as they wish, as these agreements are voluntarily bilateral treaties between independent nations. Yet, when you look at how most double taxation agreements are structured, you'll find that they often have the same provisions. Typically, these agreements outline criteria to determine tax residency when doubts arise. So, if the person has spent at least 183 days in one of the two countries, including short absences, they will be considered a tax resident of that country. If they haven't spent 183 days in either country, they will be a resident in the country where they have a permanent home, meaning a place where they can habitually reside. Third, if they have a permanent home in both countries or neither, they will be a resident in the country where they have closer economic ties and family ties. If ties can't be determined, they are a resident in the country where they habitually live. And finally, if habitual residence can't be determined, they are a resident in the country where they have citizenship. And then actually, there's also the provision that if you're not citizen of either countries, the two countries will negotiate to decide where the tax residency should be. Clearly, this isn't ideal for someone aiming to establish tax residency in Paraguay. There is only one situation when a double taxation agreement might work in your favor, which I'll explain to you shortly. But in 99.9% of cases, it works against you. Take the common case of someone with tax residency in Paraguay who works online or invests and doesn't actively spend time in the country. What happens here? The first criterion, 183 days, won't apply to either country, so we move to the second one. Many people have a permanent home in Paraguay because they bought or rented property, or they use a concierge service like the one we offer. However, a concierge service can't always be considered a true permanent address for year-round residents. That brings us to the third criterion, economic and family ties. Having a RUC, tax declarations, tax residency certificate in Paraguay, and even a local bank account can be very helpful to prove the centrality of your economic interests in Paraguay. If you don't have a spouse or children considered residents in another country, having a RUC at the center of your economic activity in Paraguay is usually sufficient. However, if you have dependents such as a spouse or children who are not officially residents of Paraguay, problems can arise. Economic and family ties are usually treated equally in almost all double taxation agreements worldwide when determining a person's residency. So in this case, you need to demonstrate additional factors such as having lived in Paraguay longer than in your home country during a given year. If the nationality criterion comes into play, it would double the difficulty for many people with tax residency in Paraguay. So basically, as you can see, when we look at those provisions, double taxation agreements often bring significant complications. These agreements override the domestic laws of the individual countries, taking precedence in governing scenarios covered by these agreements. So remember, two countries don't sign such agreements to help you pay fewer taxes. On the contrary, they aim to ensure you pay as much as possible, especially in Western countries. Nothing about these agreements is designed to help you. But now what happens when two countries do not have a double taxation agreement? In this case, leaving your tax residency is as simple as complying with the laws of the country that you are leaving. In 95% of cases, a country considers you no longer a tax resident once you obtain tax residency somewhere else and you live outside of its border for more than 183 days a year. this is a much simpler criterion compared to the exhaustive list of rules in double taxation agreements. Some countries like Germany even allow you to leave their tax residency without moving to another country. This lets you remain stateless for tax purposes, but there are significant challenges right there. I've worked with clients who regularize their status by taking residency in Paraguay after 1, 2, or 3 years without any tax residency, but 3 years is the longest they survived, because this situation is unsustainable in the long term due to problems like inability to manage bank accounts, perform large financial transactions, or demonstrate transparency about the origin of funds because they can't be declared anywhere. But that's a topic for another video. Let me know in the comments if you'd like a video on what happens when you erase your residency everywhere and the risks of being stateless for tax purposes. But now back to our discussion. Our goal is to operate as easily, directly, and efficiently as possible. So instead of navigating a long list of rules like in double taxation agreements, we can simply follow 1 or 2 straightforward rules from the country we're leaving, making it easier to demonstrate that we have left tax residency there and shifted it to a new country. Take my case as an example. As an Italian citizen who moved to Paraguay and spent a few years like a digital nomad before settling here permanently, there's no double taxation agreement between Italy and Paraguay. All I had to do was just stay out of Italy for more than 183 days and move my business operations outside of Italy, including obtaining a RUC in Paraguay to shift my economic interests to a non-Italian jurisdiction. Simple, easy, intuitive. No other long list of requirements. On the other hand, my friend Eduardo, who has lived and worked in Dubai for 8 years, continues to face audits from Italy despite being settled in Dubai, and even starting a family in the UAE. This is because the UAE is a blacklist country for many nations, while Paraguay is not. So sometimes even unilaterally, the country where you move to can have an influence on your home country. But hey, I told you there's just one case in which it's actually very beneficial if there's a double taxation agreement. And this applies to countries that have a double taxation agreement with the US for certain types of income. So in some cases, it's advantageous to set up an LLC in a country that has a good double taxation agreement with the US to reduce taxes. There are these withholding taxes that are not paid directly to the government, but are deducted by the payer. For instance, those doing business with Amazon Kindle know that Amazon is required to withhold 30% of royalties for entities based in a country without a double taxation agreement with the US. So placing your LLC in a country like Estonia or the UK can lower this rate, as this depends on the specific agreement. The same applies to US companies paying dividends. If you're investing as a resident of a country that does not have a double taxation agreement with the US, 30% of the dividends will be withheld. Solutions include investing in accumulating ETFs or selling shares before the ex-dividend date to rebuy them the following day. However, if you rely on income such as dividends or royalties, you may want to establish an LLC in a country with a favorable withholding rate in the agreement with the US, and you can still base your personal residency in Paraguay. I hope this clarifies why you don't want your country and Paraguay to have a double taxation agreement. As always, reporting from Asunción, that's all for today. See you in Paraguay!